In this morning's U.S. Bank Economic 360, Jim Russell is back, just in time for cooler weather and a look at third quarter earnings. While always important, this particular earnings season will allow us to assess the growth prospects not only for the balance of the year, but give us an early peek into 2015. Jim joins Business Courier editor Rob Dahlmeyer in the studio with his unique perspective. Gentlemen.
Thanks, Peg. Jim, so the third quarter's over, but we don't know yet exactly what happened in the third quarter.
Right.
What are the expectations for the third and fourth quarters, and maybe more importantly, are companies going to hit these expectations?
Yeah, Rob, it's a good question. Good morning. Third quarter expectations are for modest growth. And let's take a look at a couple of maybe trend lines on what that looks like right this minute. Year-over-year earnings in the third quarter are expected to be up 5%. In the fourth quarter, are expected to be up about 13%. Now, we at U.S. Bank Wealth Management feel that's a little bit aggressive, and candidly, we do feel that companies will meet third quarter, probably exceed third quarter earnings estimates, but probably fall short of that fourth quarter number. Earnings in the past have really progressed very nicely. You can see some of the chart here, some history. We have a dividend chart here as well. Companies have really progressed very nicely on dividends. You can see that 45-degree angle there, and also operating margins, which is extremely important, and that has been very flat at historically very high levels, and you can see that trend line there as well. So I think there are maybe some puts and takes. Third quarter likely to be better, fourth quarter likely to be slightly less than expectations.
And what are management teams telling us about this? Or what are they going to tell us about this?
This is the key, and that is the market is a forward-looking mechanism, and in fact, the markets have been very volatile over the last, let's say, 2, 3, 4 weeks. The market hit an all-time high in the middle of September. We're only 4% off that all-time high right now, but what management teams are likely to tell us, Rob, is that the strength of the U.S. dollar is hurting revenues for multinational companies. Secondly, Europe and China, which are about 15% of S&P 500's revenues on a consolidated basis, are very weak right now. So while the United States appears to be picking up some degree of economic momentum here in our own backyard, the countries around us are probably falling off just a little bit. Not off a cliff, no disasters, but growth rates maybe are not going to be what was once expected. So not only is the fourth quarter being adjusted down in terms of earnings expectations, as mentioned a minute ago, but probably 2015 as well. That's causing the market a little bit of a pause.
Now, unemployment is down pretty much across the board to some really nice low numbers, sometimes below 6%, but how about job growth? We're seeing that.
Yeah, Rob, it's a great question. It's on everybody's mind. The job growth numbers are starting to make some sense finally. 5.9% unemployment, 248,000 jobs created in the month of September. The last prior 2 months revised up in terms of job growth. Importantly, the job openings that are out there and available right this minute are at a 13-year high.
Wow.
Over 4.8 million jobs are open and available, so it's just a matter of matching skill sets, geographies, and other probably important dynamics, but that itself looks like it's going to make some sense throughout the balance of 2014 and be a bit stronger in 15, probably leads to some wage growth as well.
Wage growth, strong dollar, these are not conversations we've had much recently.
That's right.
Well, thanks for being here, Jim.
Yes, sir.